Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Avino Silver and Gold.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Usually when we sit down to analyze a resource stock, especially precious metals, I have to mentally prepare for a talk about patience.
Oh, absolutely. It's the slow burn. You buy it, you tuck it away, and you hope for the best in 5 years.
Exactly. But today's it's completely different. I was looking at the charts this morning, and I honestly thought I had the wrong ticker symbol up.
Okay.
We are not looking at a slow burn. We are looking at a stock, Avino Silver and Gold, that has posted a 663% return over the last 12 months.
663%. That sounds like an AI startup, not a silver miner. That is a massive number.
It's astronomical, and it isn't slowing down. Just in the immediate term, the stock surged nearly 20%, 19.4 to be exact, to hit $9.35.
A new 52-week high.
Broke right through it.
Okay, but I have to be the skeptic here. I mean, whenever I see a move that vertical, my alarm bells start ringing. Is this just retail FOMO?
That's the first thing I checked. It's the right question to ask. But if you look at the trading data, the volume on this move was unusually high.
And why does that matter so much? I mean, high volume is high volume, right?
Not really. A price spike on low volume is flimsy. It's easy to push around. But a breakout on heavy, sustained volume, that suggests conviction.
You mean it's not just day traders?
It suggests institutional money is likely establishing a position. The big fish are getting in.
But still, 600% in a year, even with volume, that just screams bubble to me. Is there anything real backing this up?
Well, that's the big question. We looked at the quantitative sentiment scoring first. The algorithm is reading everything, and the weighted sentiment right now is strongly bullish.
So even neutral news gets a positive spin.
Precisely. The market is pointing in one direction. You usually see some skepticism creep in when a stock runs this hot, but not here. The sentiment is robust.
Okay, but sentiment is fickle. It can turn on a dime. Let's get into the engine room. What are the hard numbers driving this? You don't get a return like this on good vibes alone.
No, you don't.
Yeah.
It really comes down to their third quarter 2025 numbers. They were, frankly, record-breaking. They posted revenues of $21 million.
Wow.
Which is up 44% year over year.
44% revenue growth is impressive for a miner. But I was looking at the report, and the number that really made my jaw drop wasn't revenue. It was the net income.
I think I know where you're going with this.
The bottom line, net income surged 559% to $7.7 million. How is that even possible? Revenue up 44, but profit up over 500.
It's a textbook case of what we call operating leverage.
Okay, break that down for someone who's not an accountant.
Sure. Think of a mine. You have huge fixed costs, right?
Yeah.
The lights, the trucks, the staff.
Mm-hmm.
It costs about the same, whether you pull out 1 ounce or 1,000.
The overhead is the overhead.
Exactly. So once you cover those fixed costs, almost every extra dollar of revenue drops straight to the bottom line. It's pure profit.
So their costs didn't scale with their revenue. They're just keeping way more of every dollar they make.
That's why the net income exploded. And you see it in the margins, too. Their gross margins are sitting at nearly 48%.
Which is huge for an industry where you're literally digging rocks out of the ground.
Massive. And operating margins are around 35%. This isn't just luck with silver prices. This is a very efficient operation.
And they're delivering on their promises. I saw the full year 2025 production hit 2.6 million silver equivalent ounces.
Right. Which means they met their guidance.
Yeah.
They did exactly what they said they were going to do.
Okay, so record everything, but there has to be a trigger. Miners don't just become 500% more profitable overnight. What changed?
The game changer is a project called La Preciosa.
The precious one. Sounds about right.
It's a new silver project in Mexico. But the thing that stands out to me isn't just that they have it. It's the speed of execution.
Speed is not a word I associate with mining. I think of delays and budget blowouts.
Exactly. But Avino went from the first blast to initial production in just 8 months.
Wait, 8 months? That's lightning fast. That points to some serious operational expertise.
It does. And it's not just more volume. La Preciosa is changing their output mix.
How so?
It's shifting them much more towards silver. In the fourth quarter, over 50% of their output was silver. Silver production itself was up 22% in that quarter alone.
So they're becoming a primary silver producer right as the market is getting hungry for silver. Impeccable timing.
Yes. And it creates a kind of competitive moat. They have the established Avino Mine, which is the workhorse paying the bills, and now they have this new high-grade project coming online.
The steady income from the old mine funds the high growth of the new one. It's a balanced system.
Exactly. It lets them scale efficiently, even if the commodity markets get volatile. It's a flexibility a single mine operator just doesn't have.
It sounds great. But here's my cynical side again. When a company expands this fast, they usually burn through cash. So many small miners are cash poor.
That's the classic miner's trap, isn't it? Growth at the cost of shareholder dilution.
Exactly. So are they running on fumes?
Far from it.
Mm-hmm.
This is where the story gets really unique. We need to talk about the balance sheet. As of December 31st, 2025, Avino is sitting on about 100 million US dollars in cash.
100 million in cash. For a company this size, that's a war chest.
It's a fortress. And look at the debt. Their debt-to-equity ratio is 0.03.
0.03. That's basically a rounding error. They have no debt.
It's incredibly low leverage. No bank is breathing down their neck.
I love that. But I know you like your technical metrics. Is there a number that sums all this financial safety up?
There is. It's called the Altman Z-score.
Okay, explain that like I'm 5. Why should I care?
Think of it like a corporate credit score that predicts the chance of bankruptcy in the next 2 years. Anything below, say, 1.8 is the distress zone.
1.8 is the danger line, and above 3 is safe. Where's Godo?
Their Z-score is 17.64.
Wow. Okay, so 17 versus a danger line of 1.8. That's extreme safety.
It indicates incredibly robust financial stability. And the implication for you, the shareholder, is huge. They don't need to dilute your shares to fund their next expansion.
That's the key. Growth is coming from their own profits, not out of my pocket. They can self-fund.
They control their own destiny.
So we've got the growth, the cash, the margins. Who else is noticing this? Is the smart money moving in?
Oh, they certainly are. We saw a very interesting move from Trek Financial.
What did it do?
In the third quarter, they raised their stake by nearly 130%. They hold over $5 million worth of shares now.
130%. That's not just rebalancing. That's doubling down. That's a statement.
We call it cluster accumulation. When you see a fund adding that aggressively, it signals they see more upside. They're not just dipping a toe in.
But the Wall Street analysts seem a bit divided, don't they? The price targets are kind of all over the place.
It's conflicting, which is common when a stock moves this fast. The consensus is a moderate buy. But look at Roth Capital. They just raised their target from $550 to $725.
Hold on. The stock is trading at $935. A target of $725. Are they just way behind the curve?
They kept a neutral rating. It's a classic case of analysts being reactive. The stock has moved so fast, their models haven't caught up. They're chasing the price.
So the market is way ahead of the experts on this one.
It seems so. But, to be fair, other analysts do have strong buy ratings with targets around 950. So some see it as justified. It's a battleground.
Okay, so looking forward then. We know what they've done. But why should anyone buy at $9.35? Hasn't the easy money been made?
The story now shifts to sustained earnings growth. The projection for next year is 168% EPS growth.
168%.
Yes. For context, the general market expectation for a high-growth tech stock is maybe 24%, so this is expected to far outpace even the high flyers.
That's serious growth. But I've also heard some rumors, and let's be clear, this is speculative. Talk of a 3-mine expansion plan.
This is the really exciting long-term angle. It's unconfirmed, but it makes sense. They have the revenue. They have that 100 million in cash. The rumor is they could triple production by 2029.
Tripling production. If they're this profitable now, with a rising silver price, the math on that gets pretty wild.
It does. And this is where some of the valuation models suggest the stock might still be significantly undervalued.
How undervalued are we talking?
In the most bullish discounted cash flow models, assuming silver prices cooperate, some fair value estimates go as high as 89 Canadian dollars.
89. And we're at 9. That is, well, that's 10-bagger potential.
If everything goes perfectly. And that's the key phrase. We should probably park there for a moment.
Yes. Perfect segue. We have to be responsible. What's the bear case? Because at $9, this stock is not cheap anymore.
The bear case starts with valuation. The PE ratio is high. It's between 49 and 68 times earnings, depending on the metric.
Ouch. That is steep. That's a tech stock valuation, not a miner.
Exactly. It's a huge premium to its peers.
So what does that mean for the listener?
It means the stock is priced for perfection. The market expects flawless execution. If they miss their growth targets by even a little, or if silver prices drop, the stock could correct violently.
So the company itself is safe because of the cash, but the share price is precarious if they stumble.
Correct. And there are operational risks. We saw a small note about some negative silver equivalent numbers, which suggests they still have kinks to iron out at the new mine.
And execution risk is real. If that ramp up at La Preciosa stalls, that whole 168% growth projection just evaporates.
Exactly. The whole thesis breaks if the growth stops. You're paying for that growth.
Okay, so let's wrap this up. We have a stock that's gone vertical. We have incredible fundamentals, a fortress balance sheet, a massive growth runway, but a sky-high valuation that demands perfection. What's the verdict?
For me, the bullish score is a solid 9 out of 10.
9 out of 10. That's high confidence, despite those risks.
It is, because even with the high PE, this is a multi-year story. It's driven by a ramp-up that's actually happening and profits that are actually hitting the bank account.
It's not just theory, it's cash on the books.
Exactly, and that $100 million cash pile provides a huge safety net. They have the resources to fix problems if they come up.
So here's the thought I want to leave everyone with. You have a company that could triple production by 2029, and silver seems to be entering a bull market. So is the current all-time high actually the floor for the next leg up? Or is the market just getting too euphoric, too fast?
That's the question every investor has to answer.
As always, thank you for listening. This has been Smart Wealth with Joshua. Do your own research, and we'll catch you in the next talk.
Goodbye, everyone.